Division 293 tax seems to catch a lot of people out because most people don't know what it is until they get this unexpected tax bill at the end of the financial year. Also, it doesn't get factored into any PRYG payments, so your employer's not going to factor it into the amount of tax that they're sending off to the ATO on your behalf. It's something that you've got to be aware of yourself and know that it's coming when you lodge your tax return. So in today's video, I'm going to explain to you exactly what Division 293 tax is, how to calculate it, how it works, and also talk a little bit about if it's still worthwhile making additional superannuation contributions, knowing that this extra tax is going to be incurred. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we're talking about Division 293 tax. So first of all, what is Division 293 tax? Well, put simply, it's an additional 15% tax on concessional contributions if you exceed the Division 293 threshold. Now, it only applies to the contributions in excess of the threshold. It doesn't necessarily apply to all the contributions. In the current financial year, the threshold is $250,000. However, there is talk in the Labor government at the moment about potentially bringing that down to $200,000. And it's a combination of your Division 293 income plus your Division 293 super contributions that make up this threshold. So let's talk about those two components now. The components which make up the Division 293 income is a combination or an addition of any taxable income, which includes assessable income minus allowable deductions, your total reportable fringe benefits amounts, any net financial investment loss, any net rental property loss, and any net amount on which a family trust distribution tax has been paid, less any super lump sum tax elements with a zero tax rate, and less any assessable first home super saver released amounts. Where a lot of people typically get caught out is in those ad hoc years where they have a big taxable income year. And that might be due to things like a realized capital gain, a big bonus, or a termination payment, or something like that. Something which pushes them over this threshold. The next component is your Division 293 super contributions. And this is basically any concessional contributions less any excess concessional contributions. And concessional contributions include the following. Your employer contributed amounts, so that includes any SGC, salary sacrifice, or employer additional contributions, other family and friend contributions, assessable foreign fund amounts, assessable amounts transferred from reserves, personal contributions for which you've been allowed a tax deduction, and of course defined benefit contributions. So if the sum of your Division 293 income plus your Division 293 super contributions when added together exceeds the Division 293 threshold, then that's when the additional tax is going to apply. And the tax is basically levied on the lesser of the Division 293 super contributions and the amount you are in excess of the threshold. So that probably sounds like a lot of gibberish at the moment, but to clear it all up and help explain it further, let's go through a couple of examples. Jane earns $230,000 and her employer SGC entitlement is $24,150. She also has a family trust which distributes her investment income of $10,000. Now we start by calculating Jane's Division 293 income and Jane's Division 293 super contributions. So the Division 293 income is $230,000, which is her salary, plus $10,000, which is the amount from her family trust, which gives her Division 293 income of $240,000. Jane's Division 293 super contributions is only the amount of her SGC entitlement, which is $24,150. So if we add up A and B, we get $264,150. She has exceeded the Division 293 threshold by $14,150. The taxable contribution is a lesser of the Division 293 super contribution, which is $24,150, and the amount in excess of the threshold, which in this case is $14,150. So in this instance, the taxable contribution is going to be the excess of $14,150. Jane would be required to pay Division 293 tax of $2,122.50, which is the excess times 15%. So that little scenario showed us a situation where a partial Division 293 tax would apply. Now let's look at a little scenario where Division 293 tax might apply to the full amount of concessional contributions. Now let's assume that Jane's income remains the same, but she has a larger than expected profit distribution from the family trust of $100,000. In this instance, Jane's Division 293 income would still be $230,000, which is her salary, plus $100,000, which is the distribution from the trust, giving her a total Division 293 income of $330,000. The Division 293 super contributions are still just the employer SGC paid contributions, which is $24,150. So again, if we add A to B, this time we get $354,150. She has exceeded the Division 293 threshold by a whopping $104,150. The taxable contribution is again the lesser of the Division 293 super contribution, which is $24,150, and the amount in excess of the threshold, which in this case is $104,150. So in this instance, the taxable contribution is a Division 293 super contribution of $24,150. Jane will be required to pay Division 293 tax of $3,622.50. If you are subject to Division 293 tax, you can choose to fund the tax bill yourself or take the money from your superannuation. To make a release request, you need to fill out an election form, which is then lodged with the ATO. Now you have 60 days from the Division 293 tax assessment to lodge that election. Personally, where possible, I like to fund Division 293 tax from your own savings. And the reason being is that superannuation is a very effective environment to save tax effectively for the long term. So if you can, it's best to leave money in superannuation for that long-term wealth accumulation. If Division 293 tax applies to you, a lot of people wonder if it's still worthwhile making additional superannuation contributions through salary sacrifice or personal deductible contributions, knowing that Division 293 tax is going to be applied. And the short answer is yes. Even though these additional contributions that you make are going to attract the additional 15% tax, which is going to take the total tax on the contribution up to 30%, it still makes sense because your marginal tax rate outside of superannuation is going to be higher than that. In the current 2022-23 financial year, if your income or your taxable income is above $180,000, well then you're going to get 45% marginal tax rate plus an extra 2% for Medicare levy, so essentially 47%. So if you take the money in your personal name, you've got 47% gone. If you put the money into superannuation with Division 293 tax, you've got 30% gone. So there's still a 17% tax saving there. But of course, before putting any money into superannuation, just make sure that you understand the consequences of doing so and that you're obviously eligible to do so. But that's it for me today, guys. I hope this clarified a little bit more about Division 293 tax. If you do have any questions, feel free to leave them in the description box below and I'll try to get to them as soon as I can. But thanks a lot for watching. If this video helped, please give it a thumbs up and I will see you guys in the next one.